Hi everyone, my name is Sam DeCourt, Wealth Advisor at Pi Funds, and welcome to our February market update video. Joining us today from Sydney, Michelle Lopez, who heads our Australian-based team, and of course Mike Taylor joining us from the Hawke's Bay, where you are today, Mike, heading the investment team. Hi Mike, hi Michelle.
Hi Sam.
Hi Sam.
So we'll get right into it. Mike, we'll start with you. On the headline numbers, so far the year hasn't started too badly. You sent an email around the team I think a couple of days ago where you said that under the surface, it's actually been almost as volatile as back in the GFC nearly 20 years ago. Can you talk us through what's been happening over the last couple of weeks in particular?
Yeah, so the market has been particularly volatile underneath the surface. You look at the headline numbers for the ASX, NZX, or S&P 500, and you see a market that's largely flat. So you go, oh, what's going on? Nothing. But actually, things are moving around, of course. Everybody knows what's happening geopolitically because it's usually in the front page of the news most days. And underneath the surface, what we've got is rotation trade. So, of course, all we hear about these days is AI, and AI is feared to be potentially disrupting a number of different industries. And one of the big industries that people fear that they will disrupt is tech and software, which of course is quite a big part of the market these days because almost every business in some way, shape or form is using tech as part of their business model, even fund managers. So there is some sort of fear that their business will be disrupted by AI models that can come along, or AI agents that can come along and just replicate their business model in a very quick short space of time and do it more cheaply. And so what the market has done has to the tech has said, oh, okay, we need to reprice these assets lower and reduce the multiple that people are paying for the business. So maybe things were on a PE of 25 and now on a PE of 20. But because the economy is doing pretty well, people say, well, I don't want to sell out of the stock market because, things are going pretty well. So where should I put this money? So instead, it's gone out of tech and software into defensive companies like utilities, consumer staples, property companies, and infrastructure type assets.
Mike, one of the quotes that you shared around the office a few days ago was that in some instances, the market has been shooting first, asking questions later. What does that mean?
Well, that means someone might say, take a business like Salesforce, which is a well-known software business. Very hard to, at this point, quantify what the impact would be from AI. So the market's just gone, well, there could be an impact and it could be large, so we're going to reprice the asset. Even though the company might be saying no change to current earnings, no change to the forecast, market has changed what they are willing to pay for that business.
Thank you. Michelle, over to you in Sydney. The Australasian funds of your team had a pretty awesome run of performance up until around October last year, and then it's been pretty rough for them over the last 4 months with pretty material drops. In Australia, what has been causing this? Is it exactly the same as what Mike's talking about?
Yeah, it has been a very challenging period actually for growth investors in particular, and those investors that have got a fundamental bottom-up philosophy when it comes to investing rather than thematics, which is very much how the Australasian growth funds are being run. What Mike mentioned around the AI threat absolutely has played into this. So I will definitely call out that very strong narrative that AI is going to meaningfully disrupt many businesses. And, particularly the technology sector has been affected, but not just the technology sector. We've seen it across multiple different industries, all the way through from insurers to consumer discretionary in the flight providers. But the other part which hasn't been touched on, which has impacted our funds, is just resources and the strength that we've seen in that part of the market. Now, as a reminder, the commodity sector represents about a third of our benchmark, and although we do own some exposure within that space, and in particular gold, we are underweight. So we've been caught, sort of, I suppose, on both ends, that we've been had some of our quality growth names being impacted by the discriminatory sell-off from an AI risk perspective, and also from being underweight commodities and resources more broadly.
Michelle, when the market is acting like Mike talked about, where they're shooting first, asking questions later, what are you and your team doing to analyze our holdings to make sure they're not going to be in industries completely disrupted, and to make sure they're beneficiaries?
Well, you can rest assured that we are not sitting on our hands. We've spent many hours discussing this topic internally, and we've been very proactive in identifying those businesses that operate in specialised verticals, those that have got proprietary data, they have long contract cycles, and software that's actually integrated into the workflows and offer sort of that mission critical functionality. The companies that we are backing and we are investing in do have those characteristics. They are not generic software providers. And we've got a number of examples across the different funds of stocks within that space. And then the ones that we don't feel have got that business model, we have exited. Having said that, we did that well before the sell-off happened mid last year. But it's just, a reminder that, it is quite painful seeing performance in the short term be impacted. But again, if you take a more medium-term view, which we do, this indiscriminate selling invariably is very good for long-term returns. And it's this panic-like behaviour that we're currently seeing. It doesn't happen often, but when it does happen, it does throw out some really good opportunities. And we're seeing those now, very discounted valuations in companies like the ones I've just characterised, that have been indiscriminately sold. So we are seeing opportunities in this market.
Thank you, Michelle. Mike, back to you. Recent newsletter, you're talking about your optimism for the year ahead and a number of positives. Given the last couple of weeks of volatility, are you still feeling as optimistic, and what are the key drivers?
They say there's always a bull market somewhere, and whilst some of the Australasian funds have had some challenges the last sort of few months, actually there's other products at PI that are doing particularly well out of this environment. I've already talked about the Property and Infrastructure Fund, which has had a good run, also fixed income, and even our global strategies have had a pretty good start to the year. There's been another part of this rotation twist has been a move to small cap value in the US, so our global small cap fund has been able to take advantage of that. So, as I said, it's not a concern about a slowdown in the economy. It's not a financial crisis or anything like that. It's just a rotational trade within markets. And in some portfolios we have been able to take advantage of that. So that's kind of the reason I'm optimistic.
One more thing, Mike. You've been running our Australasian strategies for nearly 18 or so years now. I think nearly 19 years. You've been through many periods of strong performance, underperformance. We're in the middle of a really challenging period for Australasia. What would you say to people who are potentially new into the Australasian funds, who are potentially feeling pretty uneasy?
What I would say is you can't deliver 15 or 20% compounded without reasonably high volatility within your strategy. That's how risk and return works. So the higher your return, typically the higher risk you're taking. So a 20% returning compounding over 15 plus years, we are taking some risk. And when we take risk, that does mean that there'll be periods where we underperform. So the 15 and 20%, unfortunately, is not achieved in a linear fashion. It is achieved in periods of years like last year, plus 40, and other years where the fund may go down. So it's part and parcel of investing for high returns. And you're right, there's been a number of cycles that I've seen, and you've been at PI for 10 years as well, Sam, so I'm sure you've seen a few to yourself. And just as we can say that the fund goes up, also there are times when it goes down, and I can say it again, the cycle will turn and we'll go back up again in the future.
And one thing I'd add to that as part of the client-facing team, of course, is if you are feeling uneasy or you've got some questions, please reach out to the team, because that's what we're here for and we would like to hear from you. Michelle, thank you for joining us. And Mike, thank you for joining us. And of course, thank you everyone for tuning in. We'll see you next month.